This is the time of year investors are getting their 1099 forms in the mail. The good news is you're probably seeing a lot of gains on those, especially your stock funds. The bad news is those gains mean taxes. I'm Jack Otter, editor of Barron's.com. I'm here with Brendan Conway, who writes our Focus on Funds blog. Brendan, you wrote a bit about how to, if not avoid, at least lessen the tax hit a little bit. Let's talk about some various techniques. First, of course, we have to throw in the important caveat that especially this time of year, people can get obsessed with taxes. You should never sort of ignore a good investment just because you might get hit with taxes. You still made money. And you should never make a bad investment just to avoid taxes.
Yeah, no, Jack, I think those are all really key points. And then it's also worth emphasizing, I think, that one of the reasons people care about it more right now is not just that the market has done so well, but that the losses that have been on your fund's books, losses that were suffered during the financial crisis, they can be held against future returns for tax purposes. A lot of that is just gone. A lot of that has already been used. So managers are actually having to, pay the piper.
And so let's talk about the techniques you can do to avoid that. First of all, asset location, right?
Yeah, really, a key question, Jack, is do you have funds that are tax efficient in your taxable accounts? And do you save the ones that are less efficient for an IRA or something that is more tax advantaged? Just following that, just making sure you have those ducks in a row will get you a long way.
Some financial advisors recommend overloading your tax advantage accounts with your bond funds, keeping your equity funds in a taxable account, because not only do you have lower taxes on long-term capital gains on your tax funds, but also you might be more likely to get hit with big losses, and then you can use those to be more tax efficient yourself. Right. But there are some other steps too.
Yeah, one of them, Jack, would be if you're concerned about your manager getting gains, move to an index fund, because A, the chances that you're going to get a drastically different return from that fund are pretty slim. You might even get better. On average, we know that the index tends to beat most managers. Those funds tend to have lower turnover, and all else being equal, lower turnover should result in fewer chances to have a problem.
And if you want to get tricky, you do write about a technique where people can actually look for funds that have a lot of losses in their books. It's not a perfect solution, but can you explain how to do that?
Sure, I would, yeah. And even prior to that, one simple thing to judge how a fund will deal with tax issues in the future is just look in the prospectus and see if there's a passage in there that shows that the manager cares about this subject. Some managers don't. If there's nothing in there about tax considerations, it's a fair bet that this fund will probably hit you with a tax bill. You should put it into kind of a more tax advantage account. But one sort of strategy that was highlighted in Barron's this week is looking to actually see how much the funds have on the books in terms of losses stored up, or do they have gains. In the short run, this matters, because if they have a lot of gains, chances are they're going to have to give you a tax hit.
And if they have a lot of losses, they could put those against gains, although eventually, of course, those will run out. And it does beg the issue, if he's got a lot of losses, do you really want to invest with that manager?
In the first place.
Thanks very much, Brendan.
Thanks, Jack.